2 times and you're on board with this. I want to look at something else. Well, that's the reason why you're not doing well. Think about it. If you look at this and you practice it every single day, you're going to get good. There's no doubt about it. It's a default. It's going to happen because the market, 90% of you all know that if we are slightly bullish and there's an equal high to the left of us, you know where it's going to go. Now, the problem is you all want to know if it's going to go up there and then sell short. Why do you need to do that? If we have a range between here and this high here, this is just a single point pool of liquidity. A double high or double top, that's just another form of a liquidity pool. It's just 2 of them. But a single stop point right in here is enough for me. It's still a low resistance liquidity run. But even in the free membership area on Twitter and on my YouTube, everyone knows how to use the equal highs and equal lows as they run on liquidity. It's simple. But it's not limited to that. You can use a single high, previous day's highs and lows. Remember, that's where the large institutions are going to have their liquidity at. So, that's just one example in here. Here's another one. We have this little run up in here. So this candle's high to this candle's low. There is a inefficiency in there. Split it in half. As price hits it, you buy it right there. Boom. So you can actually see a little bit of a run in here. The market opens on this candle and drops down into the order block. Right there. That's that order block I mapped out as it happened in real time. And all it did was drop down into an order block, and I said, okay, now it's going to run up and blow out the Friday high, and then it did it. Okay, so we watched it actually on a 5-minute chart. So in fairness, you can see it. Right in here. Hits the order block right there. And then runs through. I'm out of it here. It gets stopped out here. And then the secondary run up where it's all just really being driven by the central bank. They're really pricing it higher ahead of the Brexit vote. Now, does this mean it's going to keep going higher tomorrow? I don't know. And I have a lot of members that live in the UK. They're asking me what my opinion is. I'm learning all about Brexit, just like you are. It's a new thing for me. It's a fundamental driver that is completely unique. There's nothing else like it. So I don't know. I'm going to be honest. I have to tell you, I don't know. I want to see what is going to happen just as much as you do. So a lot of movement today. You know how to practice now. Real quick so you guys can see it one more time. There's the 2 positions. And that little tiny little drop down here, there's the entry, and it has to be a little bit lower to get that fill because of the spread. So I'm right in there at the middle. That's what I hit it at. As it went through the middle of that, I hit it. Very, very, very little drawdown. I mean, that's beautiful. I bought the down close candle that made the low, that swing, and I sold it above the known liquidity pool. Now, again, this is all being shared on free member level. So people outside the mentorship, they're watching me do this. And that's fine. This is not what you got tonight. They have no idea really what drove all this. Some of them might see some things, but they don't know what I just told you. And in fact, they don't know that the 15-minute time frame here, this is a market maker buy model. Consolidation, we left the consolidation, retrace, okay, that's a distribution, redistribution, another level of redistribution. Smart money reversal, low risk buy, reaccumulation, boom, cleared it out. So there's your market maker buy model. Okay, nobody's talking about that on free membership level. Nobody's talking about it on Twitter either. But there you go. So again, that was another reason why I was comfortable buying over here, because I knew we were over here off of an area where we did some distribution. So it's going to reverse its roll over here and accumulate to the upside. And then there you go.